Welcome to the deep dive. We're here to cut through all the noise in those dense financial reports and, well, pull out the insights that really matter.
That's the plan.
Today, we are diving deep into Cyient Ltd's Q1 FY26 results. And honestly, it looks like a company betting big on a, pretty radical transformation.
It really does.
The big question we're trying to unpack is this. Can this really ambitious strategic overhaul, especially this idea of creating a startup within a corporation, can it actually re-accelerate growth and, redefine science future in such a dynamic market?
Yeah, and to figure that out, we've gone through the official earnings call transcript, the press releases, investor presentations, the whole lot, really.
Nice stuff.
It gives us that comprehensive view, lets us get beyond just the numbers and understand the strategy behind them. And what's really fascinating is just how fundamentally they seem to be repositioning the entire company.
Okay, so let's jump right in then. What's probably the biggest headline this quarter? Science completely reimagined business structure. What do you see as the most significant implications of this shift? It feels pretty fundamental.
Oh, it absolutely is. Foundational change, effective this quarter, Q1 FY26. They've reorganized everything into four distinct pillars. The idea is, clear reporting, sharper strategic focus.
Okay, 4 pillars. What's the first one?
First up is DET. That's Digital Engineering and Technology. Think of it as their traditional engineering core, the heart of the business historically. But, and this is crucial, it now excludes the semiconductor business.
Ah, okay. So that gives us a cleaner look at the core engineering performance itself.
Exactly, a purer view.
Right. So DET is the core. Now more focused. What are the other new segments?
Second is DLM Design-Led Manufacturing. This is their electronics manufacturing services arm. Still a solid foundational part of the business, bringing in revenue. Then number 3, and this is the big one structurally, semiconductors. It's been carved out entirely. It's a new, fully owned subsidiary.
Right.
And management is being very explicit here. They're running it as a, and I quote, startup investment position for accelerated growth.
Yeah.
They see a massive opportunity in that market, clearly.
A startup within a corporation. That's a really interesting way to structure it. Why do that? Why treat semiconductors like a startup, not just, another division?
Well, it signals a few things. It's not just a label, right? It suggests Cyient is okay with potentially higher short-term risk, aiming for that long-term, maybe even disruptive growth. It gives that unit the agility, potentially, of a startup. They can pivot faster, innovate without maybe the same corporate baggage, but still have the backing and resources of the parent company. No need for immediate external funding rounds, for instance.
That makes sense. Leverage the stability, but act like a startup.
Exactly. But, it does raise questions, too. How do you manage that cultural integration? Talent retention. If one part operates so differently, that'll be interesting to watch long term.
That's a really good point. Okay, and the 4th segment.
The 4th is just called Others. It's basically a bucket for the smaller, less material businesses. Aerospace tooling sits in there, for example.
Okay.
Important for diversification, sure, but for our deep dive today, we're really going to focus on the big shifts in DET and this brand new semiconductor entity. That's where the action is, strategically.
Makes sense. So focusing on semiconductors then, are they seeing any early signs that this startup strategy is actually working? Any green shoots?
They are, actually,
Yeah.
which is encouraging, for such a new setup. The order intake for the semiconductor segment in Q1, it actually beat their internal budget by about 10%.
Oh, wow. Okay.
And they say this is already translating into some early wins on large-scale ASIC programs.
Basics, custom chips, right? High value stuff.
Very high value, exactly. Custom designed for specific client needs. Plus, they brought in key leadership. Salman Arayan as CEO, Rama as CFO. They seem confident they've got the right team in place.
Hitting the ground running and exceeding budget, that's pretty significant for a brand new unit. What do you think helped them achieve that? And, can they keep that momentum going?
Well, the initial success probably comes from a mix of things. There's clearly market demand for specialized semiconductor design services, and Cyient already had existing customer relationships they could leverage. That's a strong base to start from.
Right, not starting completely cold.
Exactly. And sustainability. Well, that's the million-dollar question, isn't it? But the early signs are positive.
And you mentioned external collaborations. Anything particularly noteworthy there for this new venture?
Yes, and this is where it gets really interesting technologically speaking. Cyient Semiconductors has partnered with MIT
MIT, okay.
to develop custom RISC-V-based intelligent power solutions.
RISC-V, that's the open source chip architecture, right? Lots of buzz around that.
Precisely. It offers flexibility, customization,
Yeah.
perfect for specialized applications. And they're targeting areas like AI power delivery, industrial robots, automotive markets. These are all sectors demanding really cutting-edge, efficient power solutions. It's about embedding intelligence right onto the power architecture.
Sounds genuinely advanced,
Yeah.
but hang on, looking at the numbers, didn't this new semiconductor segment actually see revenue decline? And it posted a loss in Q1. How does that square with the budget beat and the MIT partnership?
That's a really important question. And yeah, you're right. Management addressed it directly on the call.
Okay.
They said the Q1 revenue dip and the loss were deliberate. A one-time adjustment, basically, linked to setting up the new structure. They might have shed some lower-value legacy business to really focus the new entity.
Ah, okay. Tidying up as they launch?
Sort of. They're building this business for a specific scale, targeting around $10 million per quarter in revenue. And they expected to get back to DET-level margins by Q3 of this fiscal year.
Q3, so just a couple of quarters away.
Exactly. It's positioned as a short-term investment hit for a long-term strategic gain. But, we'll definitely need to watch closely if they hit those margin targets in Q2 and Q3. That's the proof point.
Absolutely. Okay, so a calculated dip, hopefully temporary. Let's shift gears then to DET, the Digital Engineering and Technology segment. The established core, now slightly redefined. What were the main financial highlights there in Q1?
Right, DET revenue came in at $162.7 million. That's 1,393 cores.
Okay.
Growth-wise, in U.S. dollar terms, it was pretty flat, up 0.9% quarter over quarter and 1.0% year over year. But if you look at constant currency taking out the exchange rate effects,
Which gives a clearer picture of underlying performance.
exactly, on that basis, it was actually down 1.5% quarter over quarter and flat year over year. So slight pressure there.
And profitability, EBIT.
EBIT, earnings before interest and taxes, landed at 12%. Yeah. That was down 63 basis points compared to the previous quarter, so just over 0.5% drop in margin.
Okay, EBIT margin down slightly, but I noticed PAT profit after tax that looked really strong. Big jump year over year. What's the story there? How can EBIT dip but PAT surge?
Yeah, PAT was definitely robust. 163 cores, which is up a strong 30% year over year.
30%.
Yeah. The main reason for that big jump, and management called this out as a significant tailwind, was unrealized foreign exchange gains. Favorable currency movements basically gave the bottom line a nice boost.
Ah, the FX effect. Okay, that explains the divergence.
It does. Beyond the core numbers, though, they also added 14 new logos, new clients, across different industries. And importantly, their key accounts, their biggest existing clients, grew significantly up 11% year over year and 4% quarter over quarter.
Yeah.
That shows underlying relationship strength.
Good signs there. And within DET, how are those new business units performing now that they've reorganized?
Right. DET now reports under three main units. First is transportation and mobility. That covers aerospace, rail, automotive. This one showed strong performance. It grew 2.5% quarter over quarter in dollar terms and a solid 7.3% year over year.
And what's driving that?
Aerospace was the main engine there.
Yeah.
They expect continued growth and also see opportunities for cost-out deals in rail and automotive. So strength in their traditional core domains is holding up well.
Okay. And the second DET unit, networks and infrastructure.
Networks and infrastructure, that includes connectivity, utilities, geospatial. That one saw a decline, down 2.9% quarter over quarter.
Any reason given?
Management seems confident it's temporary. They expect it to stabilize and then return to growth in maybe a couple of quarters. It sounds like they're shifting the types of services they offer within those sectors, moving towards newer, possibly higher value things. So maybe a bit of transition pain there.
An adjustment period. Got it. And the third DET segment, the strategic units. What's in there and how did they do?
So the strategic units bundle together healthcare and life sciences, mining and minerals, and energy. Now, the overall segment saw a decline, down 1.9% quarter over quarter and 6.3% year over year. But, and this is the important nuance, 2 out of the 3 units within that segment actually grew. One of them even hit double-digit growth quarter over quarter.
Oh, interesting. So what dragged the average down?
It was mainly due to one specific large energy project winding down, nearing completion. So it wasn't like a broad-based weakness across healthcare, mining, and energy.
Hmm.
The underlying momentum in most of those areas seems pretty strong, despite what the headline number for the segment suggests.
That context is really helpful. Okay, this brings us to something I find really fascinating, this whole domain plus AI strategy Cyient is pushing. How are they actually using technology as their growth engine? What does domain plus AI really mean in practice? Is it just buzzwords?
I don't think it's just buzzwords. It's about differentiation, deep differentiation. It's not just, taking some off-the-shelf AI tool and applying it. The
Hmm.
key insight, I think, is leveraging their decades of deep, specialized industry knowledge.
Right, their engineering heritage.
Exactly. Whether it's aerospace, medical devices, rail, they understand the specific problems, the data, the regulations in those domains. So when they build an AI solution, it's tailored, it's high value, it's something a generic AI company probably couldn't just replicate easily.
Makes it sticky, I guess. Harder for clients to switch.
Very sticky.
Mm.
Positions them as a strategic partner, not just a vendor. And their CTO teams has really sharpened this focus. They've defined three core tech-driven offerings now: asset lifecycle management, AI-driven engineering, and quality and regulatory assurance, all leveraging that domain expertise.
Okay. And what are the underlying technologies they're betting on to deliver this?
They've highlighted four strategic tech bets: data engineering, having an AI platform, software embedded systems expertise, and product security. These are the building blocks.
And how's it landing with customers? Are they buying into this?
Apparently, the response has been encouraging. They feel they have increased credibility in these newer areas,
Yeah.
precisely because it's built on that strong foundation of their core engineering knowledge. It's combining the heritage with the future tech.
Sounds like a compelling vision. But
It's
what do you see as the biggest hurdles? I mean, executing a strategy like domain plus AI sounds challenging. Competitive pressures?
The biggest challenge is probably just the sheer pace of change in AI itself. Constantly needing new skills, adapting platforms.
Mhm.
It's relentless. And competition is fierce, from traditional ER&D players trying to do the same thing to pure play AI firms trying to gain domain knowledge.
Right.
But the deal wins they highlighted this quarter do offer some strong validation that it's working.
Okay, give us some examples. What kind of deals show this in action?
Well, they secured a pretty significant deal, over $20 million, dollars, with a communication service provider in the Asia-Pacific region. That's for wireless infrastructure rollout, core network domain knowledge needed there.
Okay, sizable deal.
And then a global leader in medical devices selected Cyient as their AI partner to set up an AI center of excellence. That's not just a project. That's a deep strategic partnership built on trust in their capabilities, both domain and AI.
An AI center of excellence. Yeah, that sounds foundational. And wasn't there a big one with Vodafone you mentioned? That sounded like a real game changer.
Absolutely. That Vodafone deal is a perfect example. Vodafone picked Science AI-powered solution called Vismon. It's for global network configuration management.
Okay.
Basically, it uses AI and data analytics to manage complex network configurations. And Vodafone reported an almost 50% drop in errors using it. 50%.
Wow, that's huge in network
It
operation.
really is.
Yeah.
And crucially, this was a corporate-level selection by Vodafone, meaning it has global potential across their operations. It perfectly showcases that domain plus AI, deep network expertise combined with sophisticated AI.
Any others that stood out?
Yeah, one more. They won a deal against a Big Four consulting incumbent,
Oh, really?
against one of the big guys. Yep. To digitize technical publications for a private jet manufacturer. That shows their domain plus digital strength understanding complex aerospace documentation and applying digital solutions effectively and winning against top-tier competition.
That's powerful validation. What about their manufacturing side, the build to spec or B to rest business? Any movement there?
Yeah, they mentioned increased traction in B2S as well. They're leveraging both their design and manufacturing capabilities. A really interesting example was delivering a unique world-class cabin management system for the D-2328 EcoJet aircraft with Deutsche Aircraft.
So designing it and building it?
Exactly, showcasing that full-scope product development capability. It's not just digital services. They can deliver the physical product too.
Makes sense. Now, beyond these specific client deals, are they making any broader strategic moves, like partnerships for talent? Because finding people with these domain and AI skills must be tough.
Very tough. And yes, they highlighted a partnership with AICTE, the All India Council for Technical Education. They're establishing an innovation cluster in Visakhapatnam.
Okay, why BizAg?
The goal seems to be building an industry-ready, diverse talent pool beyond just the usual Tier 1 cities in India. tapping into new talent sources for ER&D and tech skills. It's a proactive, long-term play to secure the talent pipeline they need.
Smart move. And is the wider industry recognizing these efforts? Any external validation from analysts?
Definitely. They rattle off quite a list. Zinnov recognized them as leaders in 11 different areas.
Right.
They got Tier 1 status in aerospace, telecom, semiconductors, healthcare, and for the first time ever, leadership in medical devices.
First time in med devices, okay.
Zinnov also recognized their strengths in digital engineering, Industry 4.0, data and AI engineering. Then you have ISG naming them a leader for aerospace and defense services. HFS ranked them as an enterprise innovator for energy and utilities. Everest Group called them a major contender for Industry 4.0.
Wow, okay. That's a lot of positive recognition across the board, especially in those strategic growth areas.
It certainly suggests their strategy and execution are resonating with industry watchers.
And they've also brought in some new faces at the top to help steer this transformation.
Yes, a few key hires mentioned. Kavita Kurup joined as Chief People Officer, crucial role given the talent focus. Aruna Roy is now SVP for the Connectivity Business Unit, and Ram Chittor is VP and head of the Healthcare and Life Sciences BU. Bolstering the leadership team seems key for managing this kind of change.
Makes sense. Okay, let's circle back to the financials for a moment. We talked about DET's PAT growth being strong, but boosted significantly by those FX gains, right?
Correct. That 30% YoY growth had a big FX tailwind component.
But the EBIT margin dipped slightly. You mentioned wage hikes as the primary reason.
That's what management said, yes. The EBIT margin dropped 63 basis points quarter over quarter, mainly because the first part of their annual wage increases hit the books in Q1.
And they made a point about going ahead with those hikes.
They did. They emphasized it was a conscious decision, a commitment to their employees, especially when some peers might be holding back on increases. They framed it as part of their people first derived from our values first ethos.
Investing in people even when margins are under a bit of pressure.
Exactly. And they backed it up by mentioning strong employee satisfaction scores, a 90 score in their internal survey, putting them in the top quartile. Suggests the investment in people is paying off in morale, at least.
That's important for retention, especially in this market. Okay, what about their overall cash situation? Healthy.
Very healthy, they stressed, both at the DET level and for the group overall. They have a consistent focus on free cash flow generation. The group's cash position actually improved by 262 crores compared to the previous quarter, so building reserves.
Solid cash position, but was there something about free cash flow conversion?
Ah, yes. Good point. While the overall cash position is strong, their free cash flow to PAT conversion ratio took a hit this quarter.
Meaning less of their reported profit turned immediately into spendable cash.
Exactly. And the reason was a one-off payment made in Q1. It related to a civil class action antitrust lawsuit settlement, about $7.1 million that they had already provisioned for previously, but the actual cash went out the door this quarter.
Ah, okay. So an accounting versus cash flow timing thing due to that specific settlement payment.
Precisely. It impacted that specific FCF conversion metric for Q1, but the underlying cash generation seems robust.
Got it. Any other sort of operational or financial housekeeping items we should mention?
Just briefly, the board approved closing down branches in the Philippines and Australia. Likely just some operational streamlining, tidying up the global footprint, perhaps.
Okay. So given all this, the restructuring, the investments, the market conditions, the FX boosts, the one-off costs, what's management's overall tone, their outlook? They're still sticking to that no guidance policy, right?
That's correct. No specific financial guidance for Q2 or the rest of FY26.
What's the message there? Why no guidance?
They're framing this period as a phase of stabilization. Basically, get the new structure bedded in, manage the transitions, then focus on reaccelerating growth. So stabilization first, growth second.
Makes sense after such big changes.
Despite the lack of formal guidance, management expressed strong confidence in the business. They feel they're well-positioned with the tech investments, the customer base, the delivery capabilities. They believe they can capitalize on opportunities as they emerge.
And did they address potential skepticism, given maybe some past challenges or the current macro environment?
They did, quite directly, actually. They made a point of stating that, in their view, they've outperformed most of our peers within the ER&D services space during what's been a generally tough quarter for the industry. So a bullish tone, relatively speaking.
Okay, putting it in context against peers. Right, so if we try to wrap all this up, connect the dots, what are the main takeaways for you from this deep dive into Cyient Q1?
For me, it paints a picture of a company truly in the midst of a major strategic transformation. They're not just tinkering, they're fundamentally reorganizing with that bold semiconductor carve-out.
Yeah, that's the big headline.
Right. But beneath that, the core DET business seems relatively resilient, and they're sharpening its focus with that domain plus AI strategy, which is starting to show results in significant deal wins. They're managing finances prudently, maintaining strong cash, even while making deliberate investments in their people and these future growth bets. It really feels like a company actively repositioning itself for the long haul.
A company in motion, making some big, deliberate bets. Okay, that brings us to our final thought. This deep dive really reveals a company actively transforming, shifting its structure, its focus, to chase high-growth areas like semiconductors and AI-driven engineering. So the question to leave you with is, what does this kind of strategic pivot mean for the future of specialized engineering services overall? And how might this specific model, the startup within a corporation, how might that influence other traditional industries that are also facing rapid technological disruption?